This week in real estate, the Bank of Canada held its overnight rate at 2.75%, the first pause after 7 consecutive rate cuts by the Bank of Canada. This pause comes because of uncertainty around US trade policies and pressures around inflation. Meanwhile, bond markets have been quite volatile over the last few weeks. A big sell-off last week pushed short and long-term yields higher as investor anxiety grew around inflation and Canada's economic stability. Fears around a US recession and how it could spill into our economy only raised volatility. Experts say that after the dust settles from trade wars, short-term yields could fall quicker than long-term yields. This would steepen the yield curve, often a sign of economic stress and central bank intervention. So what does this mean for real estate? If yields start dropping again, we could see lower mortgage rates later this year. For now, we're in a holding pattern on the variable side, obviously, and in the fixed side, and if anything, a little bit of upward pressure on fixed mortgage rates as bond yields have risen over the past couple of weeks. Predictions leading up to this Bank of Canada rate announcements were split whether the Bank of Canada was going to cut or hold rates. Even though they held rates, most experts are still pricing in at least 50 basis points of rate cuts by the end of 2025. Throughout the month of April, buyers and sellers continue to stay on the sidelines, suppressing market activity because of larger economic events. That being said, supply and demand is still somewhat balanced because we have less sellers and less buyers in the market. That's it for this week's real estate update. Stay tuned next week for an update on this evolving spring market.